This week marks the beginning of some very interesting names to release their earnings to the market, and already this morning we have three big names that have reported. We have Bank of America, we have UnitedHealth Group, and we have Johnson & Johnson. Today's episode, we're going to take a look at their earnings, we're going to take a look at their performance and see whether or not they are looking very strong for the future and if they are still undervalued. We're also going to take a very quick look now at how the market has performed just today so far. We see the majority of the market in red, although we do see some of the bigger names like Microsoft and Nvidia up, although marginally. So today could be a very good day to consider adding if you do see quality in the market. So as always, we are going to take a look at each of these three companies' earnings. We're going to see how well they have performed on the top line as well as their earnings per share. Also look at their estimated forward guidance for the year. And we'll look at the historical performance. We'll see whether or not the analysts do indicate it as a buy. We'll look at their yield as well as their historical numbers. And we'll take a very quick look at their dividend safety. Some of these companies we can do a little bit of a deeper dive. And as always, we will run every single one into the valuation model, getting to our intrinsic value, getting to our acceptable buy price given our investor margin of safety, and see what Wall Street are now saying as a price target for the next 12 months. So let's start off today with Johnson & Johnson. Now on the top line, we can see that they top their profit estimates as medical sales devices do jump higher. Now when we take a look, we can in fact see their total revenue for the period did come in line with what analysts were estimating. So let's take a look. We also have some news about a dividend increase as well. So in terms of their earnings per share, $2.71, so they did beat that. As we can see, the market was expecting a little bit lower at $2.64. And when we look at their revenue, we can see coming very slightly under $21.38 billion, with analysts who were expecting $21.4 billion. So we can see they did miss by around 20 million. And when we look at their bottom line net income for the quarter, they did bring in around 5.35 billion. Now, if we compare that to the same quarter last year, we do know, in fact, they had made a net loss. The reason for this, a few things to note. The first was the talc baby powder liabilities, which they did put through FY23, and also that did take into account the spin-off of the consumer health unit, which is known as Kenvue. Now, in terms of looking forward and the expectation for this company, they have narrowed it very slightly. In terms of the top line, they are expecting around 88 to 88.4 billion. Previously, they were forecasting a slightly wider target, but as we can see, overall, the numbers are showing it is pretty much expected to be around the same. And I think you could argue the same is to go for the earnings per share, 1057 to 1072, while their guidance earlier in the year was 1055 to 1075. So no real difference in my opinion. When you do look at their guidance, they have really just narrowed it very slightly. Now the interesting thing here is to note that they have increased their dividend by 4.2%. When we come to look at it now, we will note that this is in fact lower than the average over the last 5 years. But the only positive that I can say about this, not only are they dividend king, but they have at a minimum increased the dividend by inflation. Remember, on average over the last 40 years, inflation has increased in the US by 4%. Now, when we take a look at the performance after reporting their earnings, they are in fact down negative 1.52%. You could argue a bit of a surprise. They did announce a dividend increase as well as beating on earnings per share, as well as a top line at a minimum coming in line. So let's take a deeper dive into the numbers. Now, over the last year, a pretty poor performance. They are down over 12%. Now, bear in mind, this doesn't include those dividends reinvested. And when we look over the last 10 years, they are up a fairly measly 45%. Not the greatest return over the last 10-year period, in my personal opinion. You do want to see over 100%. And we can see they are now trading pretty much $1 or $2 away from that 52-week low. With a yield of 3.23%, we're about to see now when we look at dividend yield theory, this is the highest yield they have offered over the last 5 years. And we have two analysts here indicating a buy, Wall Street and Seeking Alpha, whilst we have quant analysts giving it a hold. Now, if you do want to get a subscription to Seeking Alpha, you can click on the pinned comment below where you will get a 20% discount. Now, in terms of looking at the metrics and the valuation, starting on the metrics, they do have the highest score obtainable. It is 99. It is very safe. Market cap 356 billion. They are a mega cap company. Now, when we take a look essentially at the last recession, if this is something you believe will occur very soon, they did in fact increase the dividend during the 07-09 crash. They had above average growth, -6%, with the S&P having -12%, and they did significantly outperform the S&P, -27%, with the S&P bringing in -55%. Now, dividend growth, as we can see here, the recently announced 4.2% increase. Bit of a shame in my opinion when over the last 5 years on average they've increased it by 6%, over the last 20 years by 8%. I was personally expecting a lot higher in the high single digits, so that is a bit of a disappointment. Now, another thing to note, they are a dividend king as they have increased those dividends for 50 years or more, and they have been paying a dividend for the last 108 years without a reduction. Now, in terms of dividend yield theory, as I mentioned earlier, it does state the company is undervalued when the current yield sits above the 5-year average, and we can see here not just undervaluation, but this is the highest yield they have offered. As we can see, if at all, it is around that COVID spike that we do see it just under 3.4%. We also see a severe sign of undervaluation purely on the forward P, 13.7. It is below the 5-year rolling of 16.4, and we can see it is notably lower than the sector P of 17.1. You do ideally on the free cash flow payout want to see a maximum of 60%. Now, they have been above that over the more recent period. It is good to note in 2024 accounts they are expecting to be 53%, but something just to keep an eye on, given the fact that it is quite low and they've only increased it by around 4%. Don't expect strong double-digit growth to their dividend year on year. Very unlikely. Free cash flow, again, it has been increasing over the longer term, but again, very inconsistent. In fact, over the more recent period, it has barely moved. If at all, it does look like it has decreased as well, if you were to look from around 2020, 2021. Positive to note, however, they are expecting to increase their free cash flow into FY24. Sales growth, again, do understand the type of company Johnson & Johnson are, a more mature, stable company. Don't expect massive double-digit growth. In fact, over the more recent period, we see one of their best years at 6%. On average, though, it isn't looking anything more than 3 to 4%, which is at minimum keeping up in line with inflation. And we can see over the longer period, their top line has gone from 74 billion to 85. Now, they have also done some share buybacks. As we can see, they have bought shares. But again, bear in mind, it isn't a massive amount over the longer term. Nonetheless, you can argue it is still better than nothing. It does return some of that excess cash to your shareholder pockets. One thing they do that's very great is that their return on invested capital figures are very consistently high. 23% in 2023, very attractive for investors. And again, that does just show that management are able to effectively allocate their capital. Now, margins, again, one thing that I love, or two things, not only above the minimums we want to see, but also consistency pretty much around the mid to high 20s year on year. And the same can be said for their free cash flow margin. This is still a very, very strong company, even though you can argue it is fairly mature. On top of that, it has one of the best balance sheets in terms of companies alongside Microsoft. And this does just solidify that when looking at the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Now remember, these signal the number of years it would take the company to pay off all of their debt net of cash on hand. Now we can see we want a maximum of 3. In fact, FY23, 0.25. FY24, 0.23. So we can understand why that dividend has the highest score obtainable, in line when as well looking at their free cash flow payout. And the balance sheet does look very strong. So let's jump into their valuation for today's episode. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, as always, when we do our deeper dives on this channel, we do run through every single one of these models. Today's episode, let's get straight into it. And for Johnson & Johnson, the essential intrinsic value is purely the average of these three models, coming to $181. Now, margin of safety at 10%, we execute on that if it meets the 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data, and we keep going till it's near that current trading price. And we pretty much see if you are buying Johnson & Johnson at a $145 mark, you are getting a 20% margin of safety, which in my opinion for a premium company like Johnson & Johnson, it is looking like a very attractive rate, especially when we are seeing the yield at a very high 3.4 to 3.5%. In terms of Wall Street and their forecast over the next 12 months, well, they see this not too far off our intrinsic value. They believe a price target of 179, with upside of 24%, and in my opinion this does classify as a buy, and we can see Wall Street believe that as well. As always though, let us know your thoughts as we do go along these stocks today. Now if you have watched yesterday's episode, I did run through the 4 stocks that I did just buy yesterday. One of them was UnitedHealth, and in today's episode we can see they have reported earnings, and in fact they have reported better than expected revenue for the first quarter, although they did have some fallout from dealing with their cyber attack. Now let's take a look at the numbers to see exactly how strongly they have performed, and we can note straight away their earnings per share looking very solid, $7.16 versus $6.61, so a very strong beat. In terms of revenue, well, $100 billion versus the $99 billion that was expected by the market. So looking very strong. One thing that I would also mention that I have mentioned before in episodes where we do deep dives of UNH, they are very consistent. They do typically beat earnings. So if you were playing probabilities, then this was going to be extremely likely. Now we can see their revenue was in fact $99.8 billion. However, if you did exclude for the cyber attack, it would be around that $100 billion mark. So something just to be aware of. It did very minimally affect their top line. Now, one thing that we do want to mention in this article that it does go on to talk about is essentially for the full year FY24, they are reaffirming their numbers on the top line as well as their earnings per share. And as we are about to find out now, after their earnings report, they are in fact up nearly 6%, trading at $471. Now, when we take a look at the analyst rating, we have one buy, one strong buy by Wall Street, and one hold. It is still trading towards the 52-week low. It is down 7% still over the last 12 months, and over the last 10 years, it is up 523%. Again, bear in mind, it doesn't include those dividends reinvested, and it does currently offer a yield of around 1.69%. Now, one thing that we didn't actually highlight in yesterday's episode when talking about this company is the performance versus the S&P 500. Over the longer term, it does tend to outperform, as we can see over the last 5 years, including dividends reinvested. It outperformed the S&P 109%, with the S&P at 76%. And when we zoom out further to over the last 10 years, we do see some significant outperformance. Now, as always, never ever look at past performance and use that to predict the future, but it is just something you can use as part of your own investment thesis and analysis. Now, in yesterday's episode, we did run through this quite significantly in depth, so we won't do that today. Do check that out if you want to see the metrics. All we will say is that 1.59% is the current yield. On dividend yield theory, we have an undervaluation signal. It has a very safe score, the safest score obtainable, and the market cap does sit at $411 billion, a mega cap company, with their latest dividend increase being 14% in June 2023, which is very typical with UnitedHealth. They do always have those double-digit dividend increases over the last 10 to 20 years. Now let's jump into the valuation. Again, do check yesterday's episode out if you do want to see the metrics behind UNH. And what we will say is, as a reminder, you can click on the pinned comment below, grab a copy of this valuation model to get to the intrinsic value of companies in your own portfolio and those on your watch list. So intrinsic value $582 with the current price, a little bump from yesterday at $471. We use a margin of safety of 10% to indicate a buy up to $524, at 15% up to $495. At 20%, it isn't quite there yet now. So right now for UNH, we do see a 15 to 20% MOS level. And in my own opinion, this still does look like a buy now, even after that earnings increase of 5 to 6%. In terms of Wall Street and what they expect, well, they still see upside 26%. Their price target remains $591. Again, indicating it to be a strong buy, as we mentioned earlier. Now, before we move to the final company, Bank of America, just to let you know, we have released our latest free weekly article, 10 stocks with massive upside. If you want to gain access to this completely free, as well as all these other articles where we do discuss some undervalued dividend stocks, click on that pinned comment below now and you can gain instant access and start reading. Now, the next company we are looking at is Bank of America Corporation. Now, this is down 4% after releasing their earnings, and we can take a look, understand what is going on. So they do in fact top their estimates on better than expected interest income as well as the investing banking arm. So in terms of the actual numbers, let's take a look. So we can see their earnings was a beat, 83 cents a share versus analyst target of 76 cents. And we also see their top line did come in slightly higher at 25.98 billion, with the market expecting 25.46. Now, interestingly, even though they had this double beat, we do see that drop on their top line as well as their share price. We can also see that their profit did fall by 18%, as well as their revenue falling by 1.6% versus the last year. So, yes, they have beat on both earnings as well as revenue, but when they do compare it to the previous year, they are in fact down. So something to be aware of with companies now starting to release their earnings. A double beat is not enough. You also have to look in comparison to the previous year, as well as taking a look at their forward guidance. Now, even with the drop of around 4%, they are still up 14% over the last 12 months. Over the last 10 years as well, above 117%, and we can see here and note their all-time highs did sit around $50 at the back end of 2021. Now, they are currently trading in the mid to upper end of the 52-week range. With 2 buys and 1 hold rating, we have a yield of 2.7% and a forward PE just under 11.5. Now, in terms of looking at the metrics, well, we can see dividend safety score 55, borderline safe. Market cap, 284 billion. They are a mega cap company. Now, when we do take a look at the last recession, well, they did cut their dividend, with the majority of banks doing the same. They had below average growth, negative 20%, and they massively underperformed the S&P with their negative 92% recession return. Now, last summer, they did increase the dividend 9.1%. Last 5 years, 11% on average. But as we can see here, on average, over the last 20 years, negative 2 due to those dividend cuts. As we can see here, once in 2007 and another in 2008. So in terms of number of years of growth, it is only 10 years with 14 years of paying that without a reduction. As we do see from 2009 to 2013, they did maintain the dividend before increasing. In terms of dividend yield theory, we do get a small sign of undervaluation / reasonable valuation, given it is not too far off the 5-year average, and the same can be said for the forward PE. And when we take a look at financials industry sector, it isn't too far off at 11.2. Now, in terms of looking at the numbers, again, with banks, we don't look at the free cash flow due to the volatility. For the earnings, we want to see below 40%, consistently below that with BAC, 31% expected in FY24. In terms of their earnings per share growth, we do see very inconsistent, whilst we do note on a more positive attitude, it is increasing over the longer term. Do note the inconsistencies that do come with this company. Positive to say, 2024, they are expecting a slight increase to the EPS. In terms of the sales growth, well, we can see here, whilst we want 3 to 7%, very, very cyclical, as we can see by some years, in fact, flat / negative, and other years, single-digit growth. So bear that in mind with banks. One thing that we do quite like about this company is the fact that they have done a fair amount of share buybacks over the period, around 20%. So again, that is returning excess cash, as they are giving you a bigger portion of the company. And we can see here graphically the top line over the year. In terms of the ROE then, 10% or more, what we can see here is they have managed that for a small portion of the last few years. But again, do note inconsistencies that come with Bank of America in particular. In terms of the other metrics that we do typically use for companies, it isn't meaningful for banks to use some of these, so we won't include them in our own analysis. So let's jump for BAC right into the valuation. Let's find out, is it one that is undervalued now? In terms of the intrinsic value then, it is purely the average of these 3 models, and it comes to $37.73. In terms of margin of safety then, at 10%, it is a buy around $34. It isn't too far off, around 30 cents shy. So we would say for BAC today, you get around a 10% MOS level. Now, for me personally, this isn't one I would look to buy and add a 10% margin of safety. It would need to be a lot more significant for me to even consider. In terms of Wall Street and what they believe, well, they see the share price going to $39 over the next 12 months. They see upside of 15%, so a 10% MOS level with an associated 15% upside from Wall Street themselves. As always though, do let us know your thoughts in the comments below. Are you adding to any of these? And if you enjoyed the episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.